Now, this is a question that I had a little while ago about when is the right time to get into the market, but the question could also be asked, when is the right time to change my investment option? Now, we're looking at a graph of the Australian share market here, and I'm using this graph to explain the growth side of your portfolio. So this represents largely the growth, or I'm using it to represent the growth side of your portfolio. So if you're in the ethical high growth option, this is a pseudo representation of what your investment on that has effectively done. So if we look at, back in 2007, that's where the graph extends from, back in 2007, all the way until this is about the 3rd of September. So in November of 2007, that's where we had the peak of the market. 6,726 points was the peak of the market in 2007. That's the highest the Australian share market has ever been. We've then fallen over 50%, it's actually 54% the market fell, and therefore if you were in the ethical high growth, your balance would have fallen close to that sort of value. And actually, I think if you looked at the returns, the high growth option only had 22% return, I think, that year, because there was some international investments, exchange rate changes, etc. But that's what happened in the Australian share market. Fell all the way down to 3,111 points. So a significant fall. If you were in the market, if you invested only in the Australian share market, you would have lost over half of your money. I'm sure you know people who experienced that. But if you invested at that point in time, you would have seen your assets grow 61%. So this is, I guess, relating to what Jim and Elizabeth said earlier about it's not a good time to get out of the market at this point in time. Some people did. They moved at this point in time from an ethical high growth to cash, and they locked in their losses and missed out on this return back up again. So from that point in time, so this was a kind of another high point post the GFC main event. 11th of April, it was at over 5,000 points, but it just stayed that way for the next year. And then since then, we've seen it fall again. As you can see, now we're about 4,300 points as we have a little bit of a rally at this point in time. So from that high point of April 2010 until now, the market's fallen about that 13% rate. If we just look at the last financial year, you can see that the market has gone down about 11% in terms of the Australian share market. So Australian super, I think, returned over that period in the balanced option a bit over 2% from memory. So not a bad outcome given that the market has returned a negative 11%. So that's the benefit of diversification across asset classes. One asset class is going down, another asset class is potentially going up. But in this case, it's been shares and property going down, and the fixed interest and bond return providing outperforming. So when's the good time to change your investment option? If you're moving to a lower risk option, then it's best to do it at high points. So, here or potentially here or here. The problem is we can look back and know where the high points are, but we don't know where whether this is going to be a high point and we're going to go further down here, or it's going to be a low point and we're going to start to take off up this way. So that's where no one can predict the future, and that's where you need to have a long-term strategy in place that's going to work for you, whether that's liquidating some investments now if you're approaching retirement, or whether you've got a long time before you can access your superannuation money, and you might think that, or might take an approach that I'm going to move from ethical balance to ethical growth because I can see that over the longer term it's going to potentially outperform being in that, provide a better long-term return than being in a more conservative option. There's no right and wrong answer, but if you're moving to a more conservative option, the best is to do it at a high point. Just in terms of understanding the concepts of dollar cost averaging is where you're putting money into the market over time. So if you get superannuation guarantee, 9% superannuation guarantee contributions from your employer put into your super fund, you'll be putting money into the market at points all the way down this curve and all the way back in again. So what you're effectively doing there is that you're buying assets at cheaper prices. And so once the market does get beyond this low point, you've effectively, from this point in time, have a reasonable level of return. So you can dollar cost average into the market, and you can dollar cost average out of the market as well. So slowly get out of those high risk investments over time, so that you're not doing it just at this one point here. You're doing it over time and averaging out your return. Just reduces risk. A lot of what we're talking about has to do with risk. And so Rosanna sort of summarised it in, will it be worthwhile changing now to a safe option in my super category? Well, it depends on your personal circumstances. How long have you got to invest? When will you need to use the money? Can you access your superannuation money? Can you sleep at night? The whole sleep test is an important one, because if you're not sleeping at night because you're worried about your investments, then potentially you should just have it in cash or a lower risk option so that you reduce all that stress. Combine all those factors in to make a longer term decision. Don't let your emotions sway you as the media publishes information, positive and negative. You have a long term structure or plan in place.